Let's take an example that suppose a commodity company comes out with very good quarterly numbers. People will adjust their estimates upward because profits are better than what they expected. Some people may want to go and buy in a little bit of their portfolio in that stock. But because of conservatism bias, people will not move too much. They will say, okay, let me wait for 1 or 2 quarters if there is really a trend change here or no. People who want to buy also are a little conservative, saying, let me put a small portion of my portfolio to see if it really works. If it does well, we'll add more. And some people just wait to see the numbers. So if the trend has changed and quarter on quarter the numbers move up, slowly there is a crowding that comes in. That people now take higher numbers, estimates. More and more people start buying the company's stock. And people who already bought also allocate higher allocation to these companies because now they are more confident about it.
Nimesh, studying the price actions or crowd behavior of the past, can it help us predict the future price movements that can happen?
There are certain quantitative and technical analysis tools that actually work on that belief. When I was studying about these models or these tools, it took me back to the 18th century, one of the biggest traders or the best traders of the 18th century. His name was Munehisa Honma, and he was staying in Sakata and trading in the rice futures market, which was, I think, the first futures market in the world in Osaka. So I think the exchange was established in 1710 and he started trading from, say, 1724 onwards. So at a young age, he picked up this trading. Honma believed that the emotions of traders get reflected in the prices that they are trading with. So actually the price movement, as you said, reflects the crowd behavior. And if you study that behavior, you are able to take advantage of this. So you are able to take advantage of crowd's overreaction and underreaction. So he used to collect data and meticulously put open, high, low, close prices. He used to stay about 600 kilometers away from Osaka. So there is a legend that he used to have 100 people of his own set every few kilometers between his house and the exchange. And whenever a trade happened at the exchange, through signs and symbols, they used to communicate through the whole chain to him that what trades are happening. And when he studied these patterns, he found that many of these patterns were repeating. And that actually proved his point that there is a way that people trade, their emotions get reflected in the price, and you can take advantage of that because they keep repeating it like that. He was one of the most successful traders and made, I think, by today's currency terms, maybe billions by trading. But that led to the birth of, say, technical analysis or quantitative analysis, where people believe that new information doesn't get reflected adequately in the price, and that leads to a certain continuation, which can be either manipulated or used by traders in that sense. So yeah, sometimes studying past prices does tell us something about the future.
Is it something to do with momentum then?
So one of the seminal papers written on this price action is about momentum. It was written in 1993 by two researchers, Jagdish and Titman. The beauty of this test was in its simplicity. They collected 24 years of data and they put the price action in two parts. Say the 1 quarter, 2 quarter, 3 quarter and 4 quarter performance of these stocks. So 3 months, 6 month, 9 month and 12-month price action. And they forecasted or tried to trade them on 1 quarter, 2 quarter, 3 quarter and 4 quarter basis. So 4x4 metrics. Their hypothesis was, suppose we buy the winner of the say top quartile outperformers of the 1 quarter and hold it for quarter 1, quarter 2, quarter 3, quarter 4, do we outperform? Okay, so they will buy the winners, they will sell the losers. And again, the timeline was changed to 1 quarter winners and losers, 2 quarter winners and losers, 3 quarter winners and losers, and 4th quarter. So you have a 4x4 matrix, 16 different observations. In all 16 studies, they made positive results, which means in all 16 studies, you were able to make money by buying the winners and selling the losers. Now, earlier, behavioral finance had, in 1986, written about how the reversal works. that you actually, over say 3 and 5 year period, the losers outperform the winners. And there was a retort by efficient market hypothesis fans that you're taking more risk by doing this, so it is not really alpha. Now, this is exactly opposite. You are making money in the short term by buying winners and selling losers.
Right.
And there is no retort on that. And there's no explanation why this happens.
Right.
There are some explanations, but they are all behavioral. Nothing coming from, say, academic finance on that.
Then why does this happen? And is there any explanation in behavioral finance on this?
There are actually 3 explanations or 3 theories why this happens.
Okay.
2 of them are based on the theory of underreaction to new information, that the crowd underreacts.
Okay.
One of them is about overreaction.
Okay.
So let's take one which is the most prominent theory. This is given by Barbarish, Schleifer, and Vishny. They speak about conservatism bias as one of the reasons why the momentum effect comes in, or this underreaction comes in. Now, these are very fairly complex theories, but I will try to simplify as much as I can on this. So, according to conservatism theory, whenever new information comes in, people react with a bit of caution. They don't immediately take it that things have changed or the trend has changed, and they react with caution, and there is an underreaction. Let's take an example that suppose a commodity company comes out with very good quarterly numbers. People will adjust their estimates upward because profits are better than what they expected. Some people may want to go and buy in a little bit of their portfolio in that stock. But because of conservatism bias, people will not move too much. They will say, okay, let me wait for 1 or 2 quarters if there is really a trend change here or no. People who want to buy also are a little conservative, saying, let me put a small portion of my portfolio to see if it really works. If it does well, we'll add more. And some people just wait to see the numbers. So if the trend has changed and quarter on quarter the numbers move up, slowly there is a crowding that comes in. That people now take higher numbers, estimates. More and more people start buying the company's stock. And people who already bought also allocate higher allocation to these companies because now they are more confident about it.
Right.
So then from underreaction, you at one point of time, you go to overreaction. So this is a theory what momentum works, right? You go from below to higher and more crowding comes in. So this is one of the theories that says. The second theory, again about underreaction, is by Hong and Stein. They put participants into 2 different buckets. One are the news watchers. Think of them as fundamental analysts. And the other are trend followers or momentum traders. These you can take as people who like to see price action, whether on quantitative or technical terms. So what they say is that the information about a business is disseminated slowly, where say the first group catches it. So news watchers, through their fundamental analysis, they get some private information, not insider, but private information. They've done their study, they watch certain fundamentals change, and then they start buying a particular stock if things are changing for them. As the news starts spreading, more and more fundamental analysts start noticing it, and they come into buying. But still, the price is below the fair value of that company or the rational value of that company. That's where the underreaction is. As the price starts moving up, news starts spreading, and actually the numbers start showing it, then the price traders also or momentum traders also start coming in.
Okay.
And then they actually take the price up much higher. Ultimately, it goes into, again, the overvaluation zone then. So this, again, movement from underreaction to overreaction creates a momentum effect.
You mentioned that there's a model on overreaction also.
Yeah, this one is similar to, say, George Soros's theory of reflexivity, that rising prices increase people's confidence and more people start coming in. So rising prices affect people's perception, and people's perception then again reflects into rising prices. So this theory is given by Daniel, Hirschleifer, and Subramaniam. What they say is when analysts, fund managers, they start collecting information, or investors start collecting more information. They conduct surveys, they meet the management and study the trends of the business. This information typically gives them overconfidence that they can forecast much more accurately. And then they start buying into. So overconfidence leads to buying of this, purchasing more of a particular stock, or a company. Now, if the following information or news that comes in is positive, even if it is priced in earlier, people tend to get more overconfident and keep buying. So if the positive momentum comes in, they keep buying. And that leads to an upward movement. There's also another aspect. If the next information comes is negative, people tend to react less because they don't change their position quickly. This can be given to a self-attribution bias that I can't be wrong. It's just one, you rationalize it, or this is just one bad news. So people tend to stay with that initial theory. More and more people coming in as prices start moving up, and that leads to overvaluations going up further. Only when, after a sustained number of bad news, that the price reverses. Till that time, it keeps moving upward, because you don't sell if some negative news comes, but buy more if you keep moving up. If you see the three theories, how they are set up is, the first theory that we spoke about conservatism bias. Many a times it happens in commodity stocks. If you look at the second by Hong and Stein, when we were looking at news watchers and momentum traders, that slow diffusion of information happens more in small cap companies. So small cap momentum can be because of that. While the DHS theory that we spoke about is more general, like, that people get more confident when news flow is in their favor and become overconfident. That is a little more generalized theory that we see in the market.
All right. And is there any consensus on which of these three theories is more popular?
Actually, there is no consensus on which theory is the most important. But you see elements of these three somewhere or the other in the momentum theory, where if certain sector or certain stocks or certain category of stocks are doing well, you see some aspects of these coming in. Now, momentum has been studied for many years now, 25 years, and there are a lot of funds that work on momentum theory, and they're making decent returns on that. Fundamental investors don't adopt this momentum theory. Like for fundamental investor, if you tell him or her that the stock is moving up, go and buy, or stock is falling, sell, doesn't work. But if fundamental analysts combine some part of momentum, saying that this is actually about a certain information that is slowly spreading, then it can be a good addition to your analysis. And combining the two, again, a good fundamental analysis with momentum analysis can actually lead to better decisions.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.